that you should be doing financially that are brain dead simple to do. And honestly, if you just did these 3 things in 2026, you're going to save yourself a lot of money and you're not costing yourself any money by not doing these. Number 1 is a high yield savings account. It's the same thing as a normal savings account, but it just pays you a much higher interest rate for having your cash in there. Even with the recent interest rate changes, you can still get between 3 to 3.5% for having your money in one of these, which is still pretty good, especially if you have some money that you're not going to touch. So let's say you have an emergency fund and you're not going to touch it, it might as well be in a high yield account generating some interest. Number 2 is a Roth IRA. That's an individual retirement account where you put in after-tax dollars, and as a result, when you invest within the Roth IRA, all of your earnings are going to be tax-free. So let's pretend you own Apple stock in a Roth IRA, and in 50 years, it's worth like $1.5 million. Well, in a Roth IRA, you won't pay any taxes on the $1.5 million if it's held within that account. A normal brokerage account, you might be taxed 30 to 40% on those gains. And the last thing you want to do is to have an emergency fund with 3 to 6 months of living expenses saved up, and I think the best part of an emergency fund is that it's psychologically empowering. So you're really not too worried about that $300 vet bill or a speeding ticket or something like that. And it also just gives you a lot of options. You get freedom and flexibility to look for different opportunities, and you get a lot of peace of mind. In future videos, I'll talk about how to allocate your money and what to invest in, so make sure to like and follow, and also let me know what you think of must do as soon as you get paid. Number 1 is to save 3 to 6 months worth of your living expenses for emergencies. So this is the money that's reserved just for those one-off expenses like a car maintenance, home repair, medical emergency, or job loss. If your recurring living expenses are $3,000 a month, target between $9,000 and $18,000. Make sure that money is earning you interest in a high yield account that's liquid, which means that you can access it at any time. There are a lot of good ones out there, and this one is currently doing up to a $350 bonus. I will leave a link in my profile if you'd like to check that out. Number 2 is to pay off any high interest rate debt. This is any debt with an interest rate greater than about 8%. Think about credit card debt, buy now, pay later debt, cash advance loans, or personal loans. The thinking here is that the stock market averages about 8% per year, but if your debt has a higher interest rate than that, then it's probably best to just pay off the debt because it will save you the most money. And number 3 is to start investing. You can do this either in a 401k, IRA, or normal brokerage account. I would then invest in low cost, passive ETFs or index funds that track the US market. Here are some ETFs that track the S&P 500, which means that by buying this one fund, you are instantly diversifying your investment across 500 of the top US companies. If you're able to set aside $500 a month from ages 25 to 65, your ending balance will be over $1.56 million. Lastly, follow me for more investing and personal finance videos. Can you realistically afford? This table, in my opinion, serves as a conservative guideline. So for example, if you make $100,000 a year, the monthly rent you can comfortably afford to pay is around $23-27 per month every single month. There are a couple of things going on here. So usually salaries are referenced pre-tax, but the rent is after tax. So back in the 1980s, the standard 30% rule was created, and that rule says that your rent should be equal to 30% of your gross income. But using gross income to calculate how much you can afford is not practical, and it can leave you stretched thin. So the better rule, in my opinion, is what I call the 35% post-tax rule. I took the salaries listed and calculated the monthly post-tax amount that you would get paid, and the rent you can comfortably afford should be around 35% of what you take home. If you live in a higher cost of living area, this might be closer to 40%, but this is all meant to fit within the broader personal finance rule of the 50-30-20 rule. That states that you should allocate your paychecks in the following manner. So it's 50% to your needs, 30% to your wants, and 20% to your savings or investments. This way, even if your rent is 35% of your after-tax income, you still have 15% left for your other necessities like transportation, utilities, and insurance. A 20% savings rate is also very, very good. So what percentage of your income goes to rent? Let me know in the comments and follow for future videos where I will dive into more personal finance. Investing is too risky. This chart will debunk everything for you and your friends. Here's the range of returns you can expect after 1 year of investing. You can see that the downside is minus 37%, but the upside is plus 52% if you just invest in stocks. But if we take a look at the 5-year, 10-year, and 20-year rolling returns, rolling just means any 5, 10, or 20-year period in this 75-year data set, you can see that they converge and get more consistent. By the time you hit 20 years, the worst return for stocks was still positive at 6% annually. Investing is risky for a short period of time. Like if you need money in the next year or 3 years, like you're saving up money to buy a house, perhaps you should not do it. But if you're investing for 10, 20, or 30 years, the data shows it's actually one of the least riskiest things that you can do. In future videos, I will show you exactly what to invest in and how you're going to open up a brokerage account or Roth IRA to start investing. So like and follow below if you want to see those and let me know what you think. And it looks familiar. Investors predict US recession in 2023. And the US now has an 85% chance of a recession in 2024. Every year you are going to see these headlines and these recessions never happened. Here's the thing, the S&P 500 in June of 2022 was trading at 4176 and today it's over 6,800. That's a gain of over 60%. If you had panic sold in 2022, you would have missed out on years of gains, so $50,000 invested back then would be well worth over $80,000 today. Recessions do happen, I'm not saying that they don't, but everyone's always trying to predict them and that's where they lose money. You can see with this hypothetical growth of $10,000 from Fidelity, if you invested in 1980 to the end of 2022, if you had stayed invested all of the days, your balance would be worth over $1.08 million. But if you just sit out the best 5 days of that period, so just 5 days over a 42-year period, your gains would be 38% less. Unless you're retiring soon, you're better off just staying invested in the markets and try to insulate yourself from the headlines. In future videos, I'm going to dive into the data around making the best decisions when it comes to growing your money, so if you want that, please like and follow and let me know what you think.